The numbers which we arrive at after doing all the valuations that we do are measured in a unit called currency. What does this currency mean? What is a fiat currency? What is monetary system? What is a gold-backed currency? What is the evolution of currency throughout the history? In this assignment 7, chapter 7 of Advanced Financial Modeling, Stock Research and Valuation course and internship, we learn all about that. Let's get started. Namaskar, hello and welcome friends to this Advanced Financial Modeling, Stock Research and Valuation course. This course is for investors and finance students who are looking to understand how professionals value stocks. The course comes with a dual certification program. One is for the course completion and one is for internship completion. So for those who are interested in enrolling to the course certification program, the details are given in the description and in the end of the video. You can check that out. Meanwhile, the entire course material is available freely on YouTube like this video, so you can learn it freely anywhere, anytime. Students from multiple prestigious colleges across India like Nrsimhanji Mumbai and IIM Ranchi have taken this internship and benefited from it. Students who are pursuing courses like MBA Finance, CFA, CA, CPA, MCom, BCom have all taken this course and benefited from it. If you are an investor or if you are a finance student, this course is for you if you are looking to understand how professionals value their stocks. What is the eligibility for this course? The good news is we have structured the program assuming that the viewer is a beginner. So from a beginning stage, if you do all the assignments and all the chapters one by one without skipping them and applying them hands-on, then by the end of this course, you are assured to have an advanced level knowledge of how stock valuation is being done. And regarding the course content, let us discuss that now. First, we come to the stock filtration. Any stock exchange if you visit, you will find that there are thousands of stocks. For example, Nasdaq has more than 3,000 stocks. NSE and BSE together have around 8,000 stocks. So to begin with, we need to find out a way where we can filter out all these thousands of stocks and reduce the number to a manageable list which we can do deep analysis on. In the first assignment and first chapter, we show you an efficient way, an intelligent way of segregating the stocks and filtering them out. In the second chapter and second assignment, we try to understand how to interpret the cash flow statement, the balance sheet, and the income statement and bring them together to do ratio analysis. Ratio analysis brings us to chapter 3 and assignment 3. In chapter 4, assignment 4, we are going to study together in a detailed way how to do discounted cash flow valuation. Apart from that, we will also learn how to do dividend discount model valuation and residual income valuation. After learning how to do discounted cash flow valuation, we get into detailed reading of an annual report. We take a company which is listed in the stock markets and we read the annual report together along with you. After learning discounted cash flow modeling and valuation, we move into valuation of financial institutions, that is, banks, NBFCs, etc. The valuation of banks and financial institutions is a bit different than the typical manufacturing company or even an IT company. So we understand how to mathematically value a bank or a financial institution in this assignment. This is assignment 6, chapter 6. Assignment 7, chapter 7 is about understanding the monetary system and the currencies. We delve deep into the history of monetary system, the evolution of currencies, and the impact of central banking policies and the state's financial and monetary policies on the economy, especially during recession times. In the last chapter, that is assignment 8, chapter 8, we move into understanding the specific analytical parameters for specific industries and specific companies. For example, a mining company is analyzed differently than a retail company. A retail company is analyzed differently compared to an IT company. An IT company is analyzed differently compared to a banking company. So specifically, each of these industries have some specific parameters. We understand what those parameters are and how to understand them in this last assignment. And once all these things are over, the main goal is for you to become capable of valuing stocks like professionals do and creating reports like professionals do. So without further ado, let's get started. The numbers which we arrive at after doing all the valuations that we do are measured in a unit called currency. What does this currency mean? What is a fiat currency? What is monetary system? What is a gold-backed currency? What is the evolution of currency throughout the history? In this assignment 7, chapter 7 of Advanced Financial Modeling, Stock Research and Valuation course and internship, we learn all about that. Let's get started.
So friends, we are in the page of Tata Consultancy Services, right? Now you can see here, there is market cap of 15.57 trillion. The current price is 4305 rupees. Highs and lows 4362331, right? Then there is free cash flow, which is 41,688 crore rupees. Now, if you go down here, you can see the quarterly results, the sales, the expenses, the operating profits, the net profits. Same you can see for the annual numbers. Profit and loss annually 62,989 crores in 2013 financial year. And right now it is 2.4 trillion approximately if you take the last 4 quarters. But there is a problem, friends. We are watching these numbers, but generally, are we keeping track of what these numbers mean? That means these numbers are denominated in rupees, right? Similarly, if you go into a American stock exchange, you will find numbers that are denoted in dollars. If you go in some European stock exchange, for example UK, you will find stocks may be denominated in euros or denominated in pounds. But these currencies, that is pounds, dollars, euros, Indian rupees, they are not constant unmoving figures, right? Now these denominations, friends, that is rupees, dollars, pounds, euros, what do these stand for? Are they gold-backed currencies? What are they? Where does their value come from? What do they stand for? Are their values constant or are they varying? Are they gold-backed or are they not gold-backed? How does the RBI or any central bank for that matter operate and create currency? Where from is this money coming? All this currency that we have right now, we have a GDP of trillions of rupees, right? Where does this rupee arise from? Where does dollar arise from? So these questions we pay much less attention to compared to these figures, friends. Now the problem is, if you are just aware of these numbers, but the value within them, which lies within the currency, they vary drastically, then all of our calculations can go haywire, right? So we need to be aware where the valuation of each of these currencies is coming from and where are they going. So what are the future valuations and how are the valuations measured? These things we must be aware of. So we need to have some knowledge that how the currencies are created, where their value comes from, and how we are looking at the future of the currencies, right? To understand in a broader sense how the equities, how the debts function and how the businesses operate. So friends, this chapter is about money, currency, where the value of these currencies come from, and what is the history of our monetary policy, and we will try to explore how the present and the future of currencies look like. So friends, let's get started. So friends, the very first form of currency was not actually coins or notes. It was the goods itself. The system of exchange that actually existed prior to currencies appeared was barter system. Barter system. That means in exchange of dairy, one could exchange grains, or in exchange of wool or clothing, one could exchange fruits. Now friends, this kind of exchange system or this kind of value exchange system had a problem. How much grains stand for how many liters of dairy, right? What is the exchange rate, proper exchange rate? And depending on the different qualities or different kinds of grains and the different qualities and different dilutions of dairies, how should they vary? If we ask this question, the problems becomes immensely more complicated, right? So this was one kind of problem. For example, somebody is trying to exchange rice in exchange of clothing. How would the exchange rate be designed? So, to measure clothing in terms of rice is much more difficult than in terms of any currency. To measure dairy in terms of grain, to measure fruits in terms of wool, is much more complicated because these are varying kind of commodities, varying kinds of utilities, and with their varying amount of values, varying amount of needs. With the needs could change in terms of the societal and cultural habits. The needs could change in terms of geography. The needs could change in terms of weather. The needs could change in terms of availability. The needs could change in terms of food habits and whatnot. So these problems complicate this barter system and it makes it very inefficient, right friends? So these are the problems which human beings involved in barter system experienced. Availability of the commodity you are trying to exchange or you are exchanging with. Fungibility. Let's say you just need 500 grams of rice and the standard is in exchange of one full clothing, you exchange 5 kilos of rice. Now in this kind of a scenario where you just need 500 gram of rice, how would you break the cloth up? You cannot break a single cloth, right? You cannot take a single you cannot take out like a single sleeve or half a skirt, right? That does not happen, that does not work. So fungibility, that is the breaking up, how finely you can break up the currency. That problem is there. Availability, depending on the demands, depending on the needs, the commodities might be available enough or might be overly available or might be not available at all. So these problems are there. Then standard exchange rates. What are the standard exchange rates? They vary in terms of geography. Let's say if you are living in a cold climate, your need for clothing is much more, right? Your need for oil is much more because you need more heat. Somebody who is living in a warmer climate will need less clothing, will need less amount of oil. So these problems are there. Standard exchange rates are not there, they vary in terms of geography, right? So these problems are there. Then lending standards. Somebody needs some amount of money to, let's say, build a house. Somebody, let's say, wants to build a house. Now, they do not know how to arrange the materials for it. Right? Now, somebody who has those materials does not know how to take interest from the person who is borrowing the materials. Let's say the person who is trying to build the house with the materials tells the person with the materials that give me your materials, I'll build the house and return you something in exchange. Now, what will be that exchange? How much will be the quantity? Will there be any interest rates? For example, let's say the person is giving bricks and the person who is building house is taking the bricks in exchange for a commitment that it will be exchanged with grains. Now the normal exchange rate of bricks and grains is something which is standardized. Let's say that is 1 brick is equal to 100 grams of grain. I'm just taking an example. Now when you are doing barter exchanges, this is the standard. But when you are lending, will the exchange rate be same or different? Will you ask for more grains? And if you ask for more grains, how much more would you ask for? So these are complicated questions. Then there comes the question of storage. If you're storing, let's say if you're storing grains, you have to keep them fresh. You can only keep them for a certain amount of time. Then let's say if you're storing some materials, bricks, that also requires some space. Maybe bricks do not rot off, but space is required, right? Maybe you have shortage of space availability. And then there is the problem of theft. Thieves can come and create losses for you. So these problems are there. Availability, fungibility, standard exchange rate, lending standards, storage, these were the problems profusely prevalent in the barter system of exchanges. And people who were exchanging were continuously adjusting and readjusting these things to find out the natural or the most efficient exchange rates. But there was a better solution awaiting human beings. Human beings decided to use certain precious metals and copper for exchange of goods. So human beings must have thought that there are different kinds of commodities, like wool, like wood, like clothing, right? Human beings must have thought that the exchange in between these items can become much easier if we use a common denomination to it. That common denomination became gold, silver, and copper coins. These copper coins or silver coins or gold coins became standards. In different geographies, different kinds of these metals or metal coins began to be used in different proportions: gold, silver, and copper. In some place, gold was the main currency, in some place, silver, in some place, copper, in some place, all three of them were used in different proportions. Like this, currency or the currency of exchange became prevalent. Gold, silver, and copper began to be used as money. Now, this was a good solution in terms of standardizing the exchange rates and fungibility, right? Gold, silver, and copper could be fungible. They could be broken up into pieces and standardized. They could be, the exchange rates could be standardized, but there were some problems also. The problem of theft came along. Let's say you are storing some precious metal, gold or silver somewhere, and some dacoits or thieves came and they stole it all up. What would happen then? So, theft became a problem. Storage. How do you store so that they are secure? How do you store them so that they are secure? This became a huge problem. Physical risk. You may lose the coins. No theft is needed. You may just lose the coins. What if you lose the coins? So these started to be the problems prevalent in the era of gold coins, silver coins, and copper coins. So human beings had already solved the problem of barter system, but they found these new problems cropping up. What was the solution to this? The solution was primarily offered by the goldsmiths of that time. They said, whatever coins, gold coins you have, you store it with us. And in exchange, we will give you the security and we will give you a proof of document. A document proof, right? Which will say that you are storing with us this many amount of coins. And we will keep it in high security. So, we will give you a document proof like this kind of a document proof which says that your gold is with us and this is the amount and you can take it back with us at a time which is written here or any time that you wish to. I owe you. So this was the first kind of storage facilities that was offered to precious metals, mainly gold and silver coins, right? Now with time, the goldsmiths realized something. They realized that if 100 persons deposited coins with them at a time, let's say they had 100 people who had deposited in their secured chambers. Out of those 100, at any single time, only 10 or 15 people asked for withdrawing those coins. Right? So, out of these 100 people, at any single time, only 10 or 15 people would come and show their IOU certificate. They will show their IOU certificate and ask for withdrawal. Rest of the coins were always stored with them. Now they thought they could lend these stored remaining coins at all times and earn interest from it. Right? So let's say they have 10 coins. 10 coins. 2 of them they keep in their coffers or their chambers. And the rest they could just lend it to other people. Right? And earn interest from it. What a great idea. Right? This is the source from where fractional reserve banking arose. Fractional reserve banking arose from this concept that at any time only a small percentage of the depositors will ask for the money back. Right? So goldsmiths So goldsmiths found that all depositors never withdrew all the money from their deposits. Lending against interest started with gold depositors' wealth. So depositors stored their wealth, and that wealth the goldsmith would use to earn interest. Now slowly it happened that because of the storage issues, because of issues of theft, because of security issues, people would not even take out their gold coins. They would never take out their gold coins. The exchanges started to happen only with the IOU certificates, that is this certificate, and this kind of a certificate, you can call them the first kind of notes or currencies. This was the first kind of notes or currencies. So this kind of currency was completely gold backed. This basically mentioned how much gold this represents, and this currency somebody could take to the goldsmith and exchange for gold. But it's a separate thing that very few people chose to do that. So we spoke about fractional reserve banking. So when banking starts, formation of banks also comes to question. So when we are talking about banking, obviously we are talking about banks. So what were the first major banks that came up? Let's have an understanding of that. So friends, let us start with the ancient Indian banking system. We can see banking system in ancient India right from 1500 BC and even before. There were specific kind of instruments called hundis. These were very important instruments for exchange of money or exchange of value between businesses. These were basically a class of promissory notes. When promissory notes were not available, these were basically the precursors to promissory notes. And these had exchange value between businesses, and they were of two kinds. One were with maturity, that is, there was a specific time they will mature, and the other class was on demand. Now these are specific signs of banking that was there in ancient India. And then there were things like interest rates on loans. There was also lending system, which facilitated credit for different professions or businesses. Right, friends? These are the early signs of banking in India. The coins that were used were precious metal coins. And you can already see the presence of promissory notes there. So these are the earliest signs that you can see in terms of banking in India. Now, let us straight away come to the era of 1600s and look at the major banking systems that were formed and the major businesses of those times. So the first one that we have to mention is the East India Company, not the British one, but the Dutch one. At one point, they had a valuation in excess of $7 trillion. Right? $7 trillion in current inflation adjusted terms. They had a valuation of in excess of $7 trillion. This is a huge valuation, friends. And obviously, the center for the Dutch was Amsterdam, and there occurred the Bank of Amsterdam. And the origins of central banking lay in there. The different methods, the different instruments of use were designed in the Bank of Amsterdam, so to say. So this is not about the history of banking, this is about the history of money. So we'll just brush through the prominent bank names and the prominent countries that were developing the banking system at that time. Then in 1668 came the Bank of Sweden, Riksbank of Sweden. This was the most prominent. And obviously in 1694 there came the Bank of England, and with it the East India Company. But friends, the major attraction lies in this picture. In America, in the early 1700s, 1800s, and even in the early 1900s, capitalism was finding new forms through the banking system. There were new acts being created, the currencies were being created and destroyed, the banks were being created and destroyed, the banks were being reformed. And in this way, the way to use capital or the way to use money or currency was finding new forms and shape in these centuries in the heartland of USA. So we'll just brush We will just take a brief overview of how the banking system was evolving in USA and try to understand their implications. So friends, we have arrived at our blackboard to discuss briefly about the US monetary history or the history of the dollar, which is basically the de facto reserve currency currently that we have. So friends, to start off, we have to talk about the early settlements of the British in USA. The early settlers of British in USA basically came with cash, right? They came with cash, but over a period of time, as it usually happens, they ran out of it. And as they ran out of it, they ran out of the resources with which they could buy commodities and goods from the indigenous people, right? From the indigenous people. And we will not be discussing about the politics of it, but we know what happened in America and what happened to the indigenous people. Now, during the early eras, what happened was uh, there was no national currency in USA. In USA, there was no national currency. And what was used in place of currency was the Spanish dollar. The Spanish dollar. Or you can say the Spanish peso that was being used. But there was no national currency. And as the cash ran out, what happened is the US British settlers or those who were sent there, they were starting to use commodities for exchange of goods. So the barter system was back again, right? The barter system was back again. And as usual, as we know, the barter system had its problems. It was the most primitive way of doing things. It was not a very convenient way of doing things, and the similar problems started to occur. So the barter system was an inconvenient process of doing things. We had to find out alternative systems. And that alternative system came when the Coinage Act happened. The 18th century US Coinage Act. This was basically the inception of a national currency, the national dollar for USA. The Coinage Act basically created the initiation of the dollar. Through this act, 3 gold coins were declared. One was called the eagle, another was called half eagle, another was called the quarter eagle. Now, the eagle basically meant $10, half eagle meant $5, and quarter eagle meant $2.5. These were basically representative of the gold coins. And the dollar notes at that time could be redeemed exactly in these terms with respect to gold. And also, silver was designated at a price of 15:1 ratio with respect to gold. That is, silver was 15 times cheaper than gold. This was the basic principle of Coinage Act. Through this, what happened was USA got its national currency. Post that, there were many events. We will not get into too much details of it. But as you know, economies go through many transformations, booms and busts, depressions and growth phases. All these things happen. So we will talk about 40 years later, something significant which started to happen. In 1837, the Michigan Act was declared. The Michigan Act was declared. And this Michigan Act basically created an avenue for people to create banks in a much easier terms. Easier creation of banks. Now this meant that in United States, multiple small free banks started to crop up. Free banks. And these free banks, many of them, what they did is they created notes. They created notes which promised redemption with gold. Redemption with gold. But this promise was basically a fraud. This promise will never be kept. And these free banks basically created a very bad name for the banks among the common people. Anybody who could raise capital worth of $50,000 and had a land and could securitize it and give the securities to the government, that person could create a bank. Obviously, this kind of a scenario led to multiple frauds, and the government of America had to take steps for it. This Michigan Act, this phase from 1837 till a phase of 1863, 1837 to 1863, was called the period of wildcat banking. Wildcat banking. In this period, United States experienced how freeing up regulations could create chaos in the economy through undercapitalized banks who would not be able to keep their promises when the people came to redeem their notes with actual money or gold. When people would come to redeem the notes with gold. This period was called wildcat banking, and that's why we are symbolizing this phase with this image. Now, the phase ended in 1863 when the National Banking Act was put into place. The National Banking Act was established by President Abraham Lincoln, and it re-established the central banking system. So the wildcat banking system or the Michigan Act was basically freeing up of the banking system and distributing it into smaller fragments and looking at how it works. Especially because during 1837 and the nearby years, there was some economic downturn that was happening and people wanted to free up the monetary system. So this Michigan Act was brought into place. But it did not work. The free banking system was filled with fraud and there were frauds happening, and the banking system itself was gaining a lot of distrust among the civilians. So to eradicate this phase and to fund the war efforts, the civil war efforts of the 1860s, the National Banking Act was brought back into place, and this re-established the National Banking Act was brought back into place, and this re-established the central banking system and the central currencies and the national currencies, that is. So this was in many ways a centralization back from the decentralization happened in the 1830s. This was basically a trace back, and this stabilized the banking system, reduced the number of small banks that had cropped up in different parts of the United States, and brought back a little bit of stability into the system. So the first phase was creating a centralized currency. The next phase that we talk about was decentralization of the banking system. And when that failed, then what we are talking about is again centralization of the monetary system through the National Banking Act, where the central bank again became the overpowering authority. And it was intended to stabilize the banking system and fund the huge requirements of money and currency that would be required in the civil war efforts. And after the creation of the National Banking Act in 1863, by 1865, all the banks in the United States either collapsed or were nationalized. But the general awareness or the general panic in the citizenry about their deposits, about the safety of their deposits, ensuring that their deposits are safe in the banks and they can be redeemed, this did not happen yet. Even after the National Banking Act, there were panics happening, there were bank runs happening and collapses happening, right? The problem seemed to be accountability. And to solve this problem of accountability came the 1913 Act or the Federal Reserve Act. The 1913 Federal Reserve Act. What it did was basically created the Fed or the Federal Reserve System of America. Right now, the news that you see, the repo rates, the news with Jerome Powell is basically deciding the rates of the Federal Reserve. So basically, with 1913 Federal Reserve Act, Federal Reserve was given the power to issue money or currency and to utilize monetary and financial tools and to utilize monetary tools with an object to create economic and financial stability. So by virtue of the Federal Reserve Act, the Fed or the Federal Reserve could do the following things. It could change the interest rates, control the money supply, issue bonds, maintain systemic stability, and likewise. These were basically the tools: issuing of bonds, controlling the money supply, changing of the interest rates. These were basically the tools through which the Fed was given the power to maintain stability and sanity in the financial systems. But did it work permanently? Actually, not really. There were still cycles happening, and in the year 1920, there was a small recession kind of a scenario that happened. This was untempered by the authorities. This was followed by the Roaring Twenties. Roaring Twenties. During this time, boom-like scenarios happened. Every stock was going up, the economy was on a roll, and everyone was thinking everything is going to be fine forever. But then came the year 1929 and September of 1929. This is the time I'm talking about. September of 1929. The Dow was at 381. The Dow was at an all-time record-breaking highs. From the early 20s, right from the 60s or 63 around it was in the early 20s, right from that level it went up straight to 381. But by that time, certain things fundamentally had changed. The fundamental scenarios had shifted while the stock market kept on booming. And then the dawn came on the markets that the fundamentals had changed. And this was the time, September of 1929. And the market started to fall down. The market started to fall down. And there is a saying that the market goes up in stairs, but it falls through the window. So whatever gains happened in the entire 20s, that 9-10 year period, that is from 63 right up till 381, was washed away, just simply washed away in a matter of 1.5 years. In the summer of 1932, Dow ended at 41 point something, 41.2 I guess. This was the historic lows for the Dow Jones in the 20th century. This entire period from September of 1929 right up till the summer of 1932, this period marked the event which we know now as the Great Depression of 1929. And what were the phenomenon of this Great Depression? Obviously, there was rampant unemployment, there was bankruptcies, there were obviously the market kept on crashing and going lower and lower. So the stock market also did horrible things to investors. These were hard times, to say the least. So 1913 made things more robust, or the attempt was to make things more robust. But even 100 years later, we can see that the market is not free from cycles. Cycles keep on happening. Something keeps on building up when we are thinking that the markets are growing, the economy is growing, everything is booming. But then every 10-12 years or every 15 years or so, the fundamentals accrue froth, and that starts to reflect in the equity markets, and the equity markets reflects it in the form of a market crash, while in the fundamental scenario or the economic scenario, what happens is what we call a recession. So this was a brief till 1929. So coming back to the monetary history, we were talking about the market crashes, but we will stick to the topic here. We were talking about the monetary history. So after 1929, what good things did happen? Well, friends, in 1940s, World War II happened. Countries ran out of cash. And in 1944, there was a new monetary system being set up, which was called the Bretton Woods system. BW, Bretton Woods system. So the Bretton Woods system basically pegged every currency, like the British pound, like the German mark, like the French franc, everything to the US dollar. Everything got pegged to the US dollar. So at that time, what happened is, because of the huge war expenses, Britain, Germany, France, and all these countries were in huge economic distress. And at that time, they turned to USA for some economic stability. So this was decided that all these countries, specifically 44 of them, I'll not go into the names of each of them, will peg their currency at fixed exchange rates with the US dollar, and the US dollar in turn will be pegged at $35 per ounce of gold. $35 per ounce of gold. So, basically speaking, every currency got pegged to gold via the dollar. So, this was thought of as a way to establish monetary stability. Obviously, besides that, few other very important things were done, like the formation of the IMF, the formation of the World Bank, and the IBRD. So these were set up to resolve financial distress in various countries and various parts of the world. Apart from this, the currencies were pegged to dollar and dollar was pegged to gold at $35 an ounce. Now, this remained fine if the quantity of dollar remained constant, because gold anyways was limited. The quantity of gold was limited. So if the quantity of dollar was kept in check, then this ratio, that is $35 per ounce, this remained valid. But it seems that USA failed. USA had to take steps which destabilized this ratio, this $35 an ounce ratio. And countries started to distrust USA to maintain the value of their currency, because their currency was pegged to the dollar, whose value was pegged to gold. So in 1966, the French became worried about the value of their currency and they wanted to reparate the gold, equivalently reparate the gold. And this was going on, this word was around, but no steps were taken. But it seemed that the French were sending a few ships across the shores to USA to pick up the gold in 1971. So in 1971, the French at last decided that we will send a few ships across the seas and take out the gold and maintain our currency value. So somehow the US got the hang of it. And what came next was the Nixon presentation. President Nixon's presentation. Let me show you the presentation.
And the American economy is by far the strong. The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
So what Nixon basically did was, he announced that dollar, which through the Bretton Woods system was pegged to gold, would no more be deemed as pegged to gold. The pegging was gone. That is, dollar is no more pegged to gold. You cannot exchange gold for dollar in simple terms. You cannot take $35 to a bank and say, give me 1 ounce of gold. This cannot happen anymore. The Bretton Woods system is dropped. And in turns, what it means for other currencies. Obviously, because dollar is no more pegged to gold, the other currencies which are pegged to the dollar, they also lose the indirect gold backing. So this is basically the rise of something, or the initiation of something called the fiat monetary system. The fiat monetary system. If you look at the modern day dollar, what is this? This is a fiat money, means it is not backed by the gold. If you look at the modern day pound, it is fiat currency. It is not pegged to gold. If you look at the modern day rupee, it is fiat currency. It is not pegged to gold. Now, What was the consequence of it? There were a few very significant consequences of it. In the 70s, huge amount of inflation occurred, especially in USA. Huge amount of inflation. The Fed chairman, the then Fed chairman, stepped in. His name was Paul Volcker. He had raised the interest rate. He had to raise the interest rates. He had to raise the interest rates in order to curb the inflation. The inflation went up as high as 12% during this decade, and the interest rate peaked at 20% in 1981. And in the same time, the gold prices also soared. In the 4-year period from 1976 to 1980, the gold prices went up from $100 to right up till $670 or north of $670. So this was the price growth that gold saw during this period. Obviously, the value of the dollar with respect to gold reduced a lot during this period. So friends, here we are talking about the interest rates between 1960 and 2020. So if you see the period here from 1970 to 1980, there was this high upsurge of interest rates. And it peaked right around 20%. And this was basically the Paul Volcker period. The price of gold was soaring and so was the interest rates. But then something of an antithesis happened to this during the dot-com crash. By the dot-com crash, we mean this period, the period of 99, 2000, 2001. During this period, what happened was there was a new phenomenon called the internet. People were able to communicate with each other, send each other mails, send each other documents through means other than telegrams or telephones. This was something called the new era. And during this period, many companies came up, especially in the Silicon Valley, which were based around this new technology called the internet. And these were online businesses. The valuations of these businesses soared. Sky high they soared, and so did the markets. The stock markets also soared along with them. And obviously a boom-like scenario happened, post which there was the 2000 dot-com crash. Obviously the valuations were not at par with the fundamentals. The valuations had shot up, and a time came when there was some panic in the markets and it spread like wildfire, creating a crash in the entire markets. This was the 2000 dot-com crash. And to recover this market came the then Fed chairman, Alan Greenspan. Alan Greenspan proposed that low interest rates or near zero interest rates could trigger the required economic recovery. And likewise, he brought down the rates through a series of rate cuts, and it came right up till 1%. This was the Greenspan era. Now, this actually created an economic growth for the next few years, but also seemed to have created something called the housing bubble. Because the lending rates were so low, people were enticed to buying houses with those low rate loans. And this created a new kind of a bubble which was called the housing bubble. And this actually took the financial system also with it. A major hit. The financial system also took a major hit because of this. And the practices of certain financial institutions which were not very well capitalized also aggravated the situations. So let us have a look at the series of events which unfolded during the 2008 financial crisis. April 2nd, 2007. New Century, an American real estate investment trust specializing in subprime lending and securitization, files for Chapter 11 bankruptcy protection. This propagates the subprime mortgage crisis. So what is subprime mortgage, friends? Subprime mortgage is basically loans given to people with low credit scores. So people have low credit scores, but you give them loans with the hope that they are going to pay back just fine. This is what created the subprime mortgage banking system. And when it collapsed, it started notably. One of the notable events was the collapse of the New Century, which was specialized in subprime lending. June 2007, the Dow Jones Industrial Average closed above 14,000 for the first time. So, parallelly, the fundamentals are going down and the stock market is going up. This is a phenomenon we see very often, right? July 30, 2007, IKB Deutsche Industries Bank announces its bailout by German public financial institution KfW. So this is industries funding bank which is announcing its bailout. So it was into some capitalization distress. It was bailed out by the public financial institution of Germany. July 31st, 2007, Bear Stearns liquidates the two hedge funds. It had a couple of hedge funds and they were not performing well. They had to liquidate the hedge funds. August 6th, American Home Mortgage, another real estate related finance company. This files for bankruptcy. August 9th, BNP Paribas blocked withdrawals from these three of its hedge funds with a total of 2.2 billion in assets under management due to complete evaporation of liquidity. Complete evaporation of liquidity means no buyers. No buyers, only sellers. This is the situation. September 28th, NetBank suffers from bank failure, filed bankruptcy due to exposure to home loans. As we're talking about, the housing bubble is unfolding here, as you can see. October 9th, DJIA hit its peak. So again, the fundamentals are going downwards, southwards, and the stock market is hitting higher and higher prices. December 2007, unemployment in US hits 5%. January 21, 2008, as US markets were closed for Martin Luther King Jr. Day, the FTSE 100 index in United Kingdom tumbled 323 points or 5.5% in its largest crash since September 11 attacks. Since 9/11 attacks, this was the largest crash. March 17, 2008, Bear Stearns with 46 billion of mortgage assets, again, mortgage assets that had not been written down and 10 trillion in total assets, faced bankruptcy. August 2008, unemployment hits 6%. Unemployment hits 6%. September 15th, I think we have all somewhere heard about this incident. Bankruptcy of Lehman Brothers, September 15, 2008. September 20th, Paulson requested the US Congress authorize a $700 billion fund to acquire toxic mortgages, telling Congress, if it doesn't pass, then heaven help us all. So the bad debt had piled up so much that the central agencies or the central bank had to step in, according to Hank Paulson. September 21st, Goldman Sachs and Morgan Stanley, I bet you have heard the names, converted from investment banks to bank holding companies to increase their protection by the Federal Reserve. Just to enhance the regulatory support, they had to change the format their companies were incorporated. So this was the situation as of September 21st, 2008. We are highlighting this because we want to understand how the financial system got totally shaken up during the 2000 financial crisis. What all were happening at that time? September 22nd, MUFG Bank acquires 20% of Morgan Stanley. Berkshire Hathaway, the company of Warren Buffett, makes a $5 billion investment in Goldman Sachs. September 29th, with most Democrats in support and Republicans against, the House of Representatives rejects the Emergency Economic Stabilization Act of 2008. Basically, the $700 billion relief fund proposed by Paulson, this was rejected. This proposal was rejected. In response, the DJIA drops 777.68 points or 6.98%. Then the largest point drop in history. This was the largest points drop in history. The S&P 500 index falls 8.8% and the Nasdaq 9.1%. Several stock market indexes Several stock market indices worldwide fall 10%. Gold prices soar to $900 per ounce. So while the stock markets were going down, the gold prices were rising during this time. So this shows a negative correlation between the gold prices and the equities, right? October 3, the House of Representatives passes the Emergency Economic Stabilization Act. So at last, the funds are allotted. They see there is no other way, the funds have to be allotted. October 16, the rescue plan was unveiled for Swiss banks UBS AG and Credit Suisse. So the problem is spreading, it's going across the globe. Meanwhile, Indonesia, Iceland, and the whole world is going through meltdowns in the market. December 6, the 2008 Greek riots begin, sparked in part by economic conditions in the country. Generally, civil wars are triggered partly, if not wholly, at least partly by economic distress of the civilians. December 16, 2008, the federal funds rate is lowered to 0%. 0% interest rates. So this is a historic event. And when we learn about what is quantitative easing, we'll learn more about what are the expansionary monetary policies that are applied during this period. December 20, 2008, financing under the Troubled Asset Relief Program is made available to General Motors and Chrysler. So the automotive companies are now being bailed out. Not only the banking companies, not only the financial institutions, even automotive companies, that is a typical manufacturing company, is being bailed out. February 27, 2009, the Dow Jones closes its lowest value since 1997. Early March 2009, the drop in stock prices was compared to that of the Great Depression. We learned about Great Depression, right? So this was a comparable incident according to some. Although in terms of numbers it was not that profuse, but still it was huge enough. March 6, 2009, the Dow Jones hit its lowest level of 6,469.95, a drop of 54% from its peak of 14,164 on October 9th, 2007. This is over a span of 17 months before beginning to recover. So this event took place over a period of 17 months. June 2009, the NBER declares June 2009 as the end date of US recession. So there was a recession and it has ended in June 2009. This was declared by National Bureau of Economic Research. So friends, now let us understand something called quantitative easing. What do we mean by that? Let me put it in very simple terms. There are two ways we can expand the money availability in the system. One is by reducing the interest rates. The interest rates, you reduce it. The more you reduce it, the more lending becomes easy. So friends, post this 2008 financial crisis, emerged a new term. In fact, it became a little more popular during this time. It is called quantitative easing. Now we need to understand what this quantitative easing basically means. So what happened in 2008? In 2008, the markets slowed down, which means basically the demands went down. The demands plummeted. Demand for real estate, demand for commodities, demand for consumables, demand for durables, everything decreased. Because whenever a recession happens, this is what happens. People stop buying too many things. And that's what happened. Now, we heard that in the year 2000, Alan Greenspan said that if we could reduce the interest rates, that will increase the demand, right? Now, by this time, this experiment was already done. Now, the central banks decided to do something else. What was that? Apart from interest rates, there is one more tool in the hands of the central banks, which is called money supply. Money supply. Now, because the gold backing was gone, because the gold standard was done with, money supply, increasing the money supply or decreasing or shrinking the money supply was no more a problem. You just had to repeat the same process of creating money and you could create more money into the system and get it into the system basically. So this money supply, increase of this money supply was the next step now. The reduction of interest rate thing was already done. Now the next step was increasing the money supply. That is, there are a set of buyers and there are a set of sellers. Now between them, the transaction is happening at a certain rate. We want this to increase. Now we want to increase this in two ways. One is by reducing the interest rates. That has already been done. Now the second thing we will do is we will increase the money supply. So here is the buyer and here is the seller. If the money supply in between is increased, then theoretically the buying may increase. This is a theory, right? This is a hypothesis that by increasing the money supply we can boost the sales or increase the demand. And this process of increasing the money supply, simply speaking, is what is called quantitative easing. This is basically direct intervention of the central banks to boost the liquidity in the markets through different means. What are those means, friends? Provision of liquidity to the banks. One of those means was provision of liquidity to the banks. This was done simply by creating new money or increasing the money supply. This also has an impact on the interest rates. It reduces the interest rates. So both the things were happening simultaneously. In fact, if you get into the technicalities of it, increasing the supply of money reduces the interest rates. It's like, if you want to get into the technicalities of it, let's say money is an asset. Now, the more of it is there in the market or more of it is there in the system, the cost goes down, right? If there is more money in the system, the cost of money comes down. And what is the cost of money? It is basically the interest rate. This comes down. And if there is less money, then the cost goes up. What is the cost of money again? The cost of money is interest rate. So by changing the money supply in the system, we are also impacting the interest rates in an inverse way. By increasing the money supply, we push the rates down. By reducing the money supply, we push the rates up. So this was done through money supply provisions, right? Absorbing a wider range of assets from markets and including it in their own balance sheet. So this was done by the central banks. For example, the Fed, right? They have a particular set of assets which they buy and sell in the markets. They were basically limited. Certain kinds of bonds, certain kinds of notes from the banks, they were, under the regulations, they were stipulated to buy and sell. Now what happened in this quantitative easing era, they increased the corpus of it. So the range of assets and the range of bonds, notes, etc. that they can buy, or the range of assets that they can buy, just the basket of it increased. So certain assets which were not there in that basket which the central banks are going to buy, they started buying. So for example, certain mortgages or certain loans, they started buying, which they were not buying previously. They started buying. So they included it in their own balance sheet, thereby absorbing those assets from the market, right? That pushed the demand up, right? So this was part of the quantitative easing. Then increasing money supply, thereby boosting exports. So increasing money supply, thereby boosting exports. Let's understand this part a little bit more, right friends? How does the increasing of money supply increase the exports also? Let's understand this. When a country increases the money supply, let's say the current money supply is M, and it increases the money supply to, let's say, a bigger number, M1. Total money supply increases, right? It becomes M1. Something happens in the foreign exchange rates. Or theoretically, it should happen. What should happen? Basically, let's say USD and INR are in fixed quantities currently at t is equal to 0. But at t is equal to 1, the quantity of USD, the quantity of US dollars, the money supply of US dollars increased with respect to INR, right? The quantity of this money increased compared to this quantity. What happens is the foreign exchange rate changes. Changes in which way? The currency which increases more in money supply should decrease in value. So USD in this kind of a scenario should decrease in value. the USD in this kind of a scenario should decrease in value because you are increasing the supply of US dollar in the entire global markets. The foreign exchange rates for USD weaken. In this kind of a scenario, what can happen is, in export markets, US products may become cheaper. US products become cheaper in export markets. And theoretically, this may result in increase of exports. Right, friends? Theoretically, this may result in increase of exports. That is what is being pointed towards when we are talking about increasing money supply, thereby boosting exports. Now we go back to the presentation, friends. So, specifically speaking, there have been three phases of quantitative easing. Quantitative easing 1, QE1, QE2 and QE3. We are just going to go through the details a little bit of these phases of quantitative easing. So first was November 2008, QE1. In late November 2008, the Federal Reserve started buying $600 billion in mortgage-backed securities. $600 billion worth of mortgage-backed securities. By March, it held 1.7 trillion of bank debt. Right? 1.7 trillion of bank debt, mortgage-backed securities and treasury notes. This amount reached its peak of 2.1 trillion in June 2010. So this is how central bank was giving certain amount of liquidity to the system by absorbing certain kinds of assets which they were not absorbing previously. Further purchases were halted as the economy started to improve. As they started to see improvement and they saw that the markets have bottomed out and they are again reviving, the buying was halted. But then again, in August 2010, when the Fed decided the economy was not growing robustly. Growing robustly can mean many things. It can mean the rate of growth. It can mean the expanse of growth, or it can mean the range of the assets that should have been growing. So all these things. After the halt in June, holdings started falling naturally as debt matured and were projected to fall to 1.7 trillion by 2012. The Fed's revised goal became to keep holdings at 2.054 trillion. So they kept buying just to maintain the levels of their assets in the balance sheet, right? They kept their absorption going on even after the peaks were reached, right? To maintain that level, the Fed bought 30 billion in 2 to 10 year treasury notes every month, right? This is how they kept it. Every month they bought 30 billion worth of assets from the system. Now comes November 2010 and the start of QE2. In November 2010, the Fed announced a second round of quantitative easing, buying 600 billion of treasury securities by end of second quarter 2011. The expression QE2 became a ubiquitous nickname in 2010 used to refer to this second round of quantitative easing by US central banks. So basically increasing these money supplies, reducing interest rates and whatnot, these are supposed to be temporary processes just to revive the economy which is in a deep kind of recession or deep trouble. Now what happened is, these things continued even after it was said that after a certain limit the provisions would be capped, that is no further buying will happen, but still after certain buying was done the provisions were extended. So after buying 2.1 trillion the peaking happened, then again every month $30 billion worth of purchasing was happening. Then after that in November 2010 again another buying spree of 600 billion treasury securities was targeted and it was executed. So retrospectively, the round of quantitative easing this time was QE2 and the preceding one was named QE1. Right? Then comes QE3, September 2012. A third round of quantitative easing was announced on September 13, 2012. In an 11-1 vote, the Federal Reserve decided to launch a new $40 billion per month open-ended bond purchasing program, and the bond purchasing program was targeted towards again mortgage-backed securities. Additionally, the Federal Open Market Committee FOMC announced that it would likely maintain the federal funds rate near zero at least through 2015. So interest rates near zero and money supply continuously increasing. These were the two tools being used continuously for an extended period. And these periods obviously phase wise because they were declared in phases. They were called QE1, QE2 and QE3. So first let us discuss what are the benefits and criticisms of quantitative easing. The benefits, let us discuss that first. Widening protection for financial institutions, obviously, because if certain assets go bad or perform badly, the Federal Reserve jumps in and protects the financial institutions. In that way, certain amount of financial stability is maintained. Then there is faster resolution to liquidity issues, lower credit risk, lower interest rates, thereby easing of borrowing. Obviously, this creates expansion of the system. Evasion of deflationary spirals. The recession does not lead to extensive deflations and depression kind of scenarios. So what they called a soft landing, that was basically what was being attempted. Boosting of exports, as we discussed, because the prices go down, the products become more competitive in the markets and exports are boosted. Now, what are the criticisms? Faster resolution to liquidity issues. Obviously, the central bank itself is guiding the liquidity issues in some way. Lower credit risk. Obviously, the banks are taking up a little lower amount of credit risk because the Federal Reserve is absorbing certain amount of assets, right? Lower interest rates, thereby easing of borrowing. Money supply increases, interest rates go down, borrowing becomes easier, and the entire system is boosted in a certain way. Evasion of deflationary spirals. So a recession very quickly can become a deflation and a depression if not guided properly. So by giving money supply or money boost in the system, the deflationary or the depression kind of scenarios could be avoided. Then boosting of exports. This we discussed previously only. By increasing the money supply, basically the export prices, they become more competitive in the markets, thereby boosting the export demands. Now let us discuss the criticisms of quantitative easing. Inflation. Obviously, if the money supply is increased, the prices of things will go up. This will lead to inflation. And how it played out, what were the impacts of it, we will discuss in a very short while. No impact on velocity and storing up of hyperinflationary energy. So, even after quantitative easing, the demand was not going up as much as the Federal Reserve wanted. So what was happening is the money supply or the money quantity was increasing, but the demand was not increasing. So there was a imbalance. That is, the money supply was not in parity with the growth, with the natural growth, right? So the money supply was far exceeding the growth rates. This can create a storage of energy in the system. Which can later lead to very high inflations or even hyperinflationary scenarios. This is one of the criticisms. Lack of trust in the system. Obviously, if the money supply is being tampered beyond a certain extent, that can lead to lack of trust in the entire system, that our currency that we are holding is not really something that can be trusted. So that can lead to spirals, different kinds of hyperinflationary spirals. In fact, systemic collapses can happen due to this. Increasing wealth gap. There is a criticism that by diluting the money, the cost of the goods is going up. Especially the essential goods, the prices of essential goods like food can go up a lot. And this can create huge amounts of wealth gap in the society. This is another criticism of quantitative easing. Contagion to other countries. Obviously, if a reserve currency like dollar is increasing the money supply, then everybody has to follow. India has to follow, China has to follow, Europe has to follow, everyone has to follow and keep up with the money supply so that there is no imbalance in the exchange rates, there is no imbalance in the export competitiveness and all that. And that can lead to inflationary scenarios in other countries also, because the other countries are also increasing money supply in parallel with the reserve currency of dollar. Wrong incentive to financial institutions. Now, when the central banks become protectors of financial institutions, the wrong incentive can be less amount of due diligence and giving loans to uncreditworthy entities or individuals. So this is one of those strong criticisms of quantitative easing. Now let us have a look at the aftermath of all these quantitative easings that happened. Now let us talk about the post-2020 era, QE4 and Powellonomics. So, March 2020, the world scenario, we'll all know what came around at that time. At that time, March 2020, Fed announced 700 billion amount of stimulus concerned with global situation at hand. So everything had closed down. There were lockdowns being discussed across the countries, across the globe. And Fed thought it was necessary to push the system by giving excess amount of stimulus. So they decided they are going to give a stimulus worth of $700 billion during that time. 2021. The US inflation soared to 4.75% from around 1.33%. So a country which is growing say 1.1% to 2% or 3%, an inflation of 1% or 2% is not that kind of a red signal. But when it goes beyond 4% or nears 5%, then it becomes a cause of concern. And obviously, the system was watching how much the inflation soars. In 2022, the US inflation soared north of 8%. Now, this was obviously a clear red flag that the money supply was creating inflation in the system. So did the QE4 work? Did it not work? Was it bad? Was it good? That is a separate question. Only time can tell that. There was a stimulus necessity at that time. Obviously, there was certain amount of stimulus which had to be given to the system to push it. But how much to give it, how much already has been given, based on that, what decision could be taken, all those things are a huge point of discussion and debate. Now we come to Powellonomics. Here is a record of the interest rates under Jerome Powell. So friends, during this phase, the chairman of Fed was Mr. Jerome Powell. And he had to take some step to curb the inflations. And these are a series of steps that he took to push the interest rates upwards. So in March 22 till July 26, the data is here. You can see 25 BPS. So 25 BPS basically means 0.25%. 0.25% of interest rate, right? 25 BPS basically means. So 0.25%, 0.5%, 0.75%, 0.75%, again 0.5%, 0.25%. Like this, the interest rates were increased. Let me take you to the exact charts now. So friends, you can see in July 2020, the rate was 0.09%. And it continues 0.1%, 0.8%. That's how it is going. Very fine. Then it starts increasing. January 2020. So from July 20, it was 0.09%, 0.08%, 0.7%, and it's going really good. Absolute near zero rates are going on. Now from January 2022, there is a change in the policy. So the rates start increasing. 0.2%, 0.33%, 0.7%, 1.21%, 1.68%, 2.33%, 2.56%. Now January 23, the rates have gone up to 4.33%. July 2023, the rate is 5.06%. July 23, we are continuing, and in August 2023, the rates are 5.33%. And at 5.33%, it is more or less flat. As of July 2024, the rates have been kept at that level, 5.33%. Now, why this was done? This will become clear to you once I show you the inflation data. Why these interest rates were brought up and then flattened from July 2023. Let's see. So friends, these are the inflation numbers that we have. So in 2020, the inflation number was 0.6%, 1%, like this the numbers were going. The inflation was very, very low. In fact, lower than people wanted. Now from 2021, this number started increasing. 1.4%, 1.7%, 4.2%, 5.4%, then it's going up. We are in the beginning stages of 2022. The inflation is at 7% and it's still going up. It's going up. As of July 2022, it is 9.1%, right? Then it is coming down. 7.8%, 6.4%, 6%, 5%. July of 2023, the inflation rates have stabilized at around 3%, right? So you can see here the rates are stable. 3%, 3.4%, 3.1%, 3.2%, like that. So from July 2023, the inflation rate went flat. And at the same time, the Federal Reserve rates also went flat at 5.33%. The rates were being increased from what dates? From beginning of 2022. So when they saw the inflation rate is reaching 8% or something, they started raising the rates. And they kept on raising it, kept on raising it, kept on raising it, till the rates reached 3%. Around 3%, right? So this entire phase from 2022, from this phase till this phase, the rates were increased. And after that, the rates were flattened. These are the inflation numbers, right? So friends, let's have a look at these numbers parallelly to have an easier understanding of this whole thing. So here is 2021, here is 2021, here is 2022, here is 2022, 2023, 2023, 2024, 2024. We can judge it from here, right? We can understand it pretty well from here. So you can see here the inflation is going up. The inflation is going up, going up, going up, right around the third or fourth quarter of 2023, right? And from 2021 beginning, Fed was watching. In this phase, Fed is watching, right? Now, during this phase, that is January of 2022, that is around here, the rate reaches 7% and above, right? Here you can see 7% and above. Here the rates start increasing. They start increasing the rates. And they keep on increasing the rates right up till September of 2023. Around September or August of 2023. Here we saw the rate was 5.33%, right? So September or August of 2023, this is somewhere around here. They started increasing the rates, let's say from this point, and they saw it through right up till around 3% levels, right? This made sure that the inflation came down to 3% or around 3%, and at that point they flattened the rates. They made the rates flat, right? They did not further go on increasing it, they kept it flat. Now the talk is that when the Fed is going to reduce the rates. This is awaited to be seen when they will be reducing the rates. We do not yet know what is going to be the time or the consequence of it. Only time can tell. The impact of QE4, let's discuss this. Raising of interest rates have contributed to taming inflation, but Fed is looking for more stability. Raising of interest rates have contributed to taming of inflation, but Fed might be looking for more stability. That's why they are not yet reducing the rates, right? In the meantime, certain banks like SVB, Signature have succumbed to the rising interest rates, right? They have gone bankrupt. It means they have gone bankrupt and they have succumbed to the rising interest rates, low deposits, and low demand for loans. Time will tell whether instead of acting through reduction of interest rates to near zero and stimulus of trillions helped or worsened in the long run. At the same time, whether rates have been raised in a balanced way for a quintessential soft landing. So, have the rates been too extreme? Have the quantitative easing been too expansive? These questions will be answered only with time. We cannot tell for sure. Only history will tell whether this was right or wrong, and there can be perpetual debate around it. But one thing we can say is the central banks do take active steps right now, these days, when some depression or recession kind of scenario happens, and they work with the tools in hand to balance the things. What the consequences are, what the impact is, how the wealth gets distributed, all these things can be debatable, but there is action there that we can see visibly. So friends, let's discuss on this blackboard what all have we discussed, right? So there have been lots of things that have been discussed and they are in a haphazard way, right? Now let us put those things together. Let's start first. First there was the barter system, right? There was the barter system. And in barter system there were exchange issues. Then this was changed to coins. This was the first form of money. For example, gold coin, silver coin, copper coin, alloy coins, all these things. Now, there were problems in this also, right? It was carrying was an issue, security was an issue, the measurements were not perfect everywhere. The solution to this was given by The goldsmiths, they took your gold coins and in return they gave you IOUs or promissory notes. The first notes, the notes that you see, the 10 rupee note, the 20 rupee note, the 500 rupee note, this was basically a primitive form of that you can take the note to this goldsmith and exchange it for the gold that you had deposited. Now the goldsmiths found that at any time only a certain percentage of people ask back for deposits, and the rest of the amount is still with them. This gave rise to fractional lending. What was fractional lending? A goldsmith, let's say he had 1000 gold coins. So he would only keep 200 gold coins with him, and the rest 800 he would use it to give loans. And only, let's say, 20% of the people came for asking for deposit. So he had the 200 gold coins. The rest he used for giving loans and earning interest. This was fractional reserve lending, the primitive forms of it. Now this gave rise to what we call the modern banking system, the reserve banking system, fractional reserve banking system. So then we talked about the big banks that came up, the Dutch. We spoke about the East India Company and the Bank of England, right? Then we spoke about the national banks of USA. This was basically the modernized version of this fractional banking that we spoke about. So the entire economy actually started to be driven by fractional reserve lending or loans. Even now, the entire system is being run by this fractional reserve lending. You will see something called the capital adequacy ratio, something called the liquidity ratio. So why the ratio? That means you do not need to keep the full amount of deposits with you. You can keep some amount of deposit with you and the rest you can use to give out loans, right? Then number 6, using of tools. The Federal Reserve and the usage of tools like interest rates and money supply. So by increasing the money supply or by reducing the interest rates, the demand could be theoretically impacted. The demand could be raised, right, during recession periods, and this has been tried. And we have spoken about how the quantitative easing played out, how the rate decrease by Alan Greenspan played out, and the post 2020 era, how the inflation started to take impact on the markets, and the steps of Jerome Powell on this, right? So the near zero interest rates were taken up to 5.33%, and it has been kept at that point, right? So we have discussed all these things. Now why we are discussing all these things? The reason, friends, we are discussing all these things is because if inflation or deflation, any of it, go out of control, let's say right now India has 6% or 5% of inflation, USA has 3% of inflation. If you just add zeros to it, if it becomes 60%, 50%, 30%, this situation can lead to total social chaos. Not only social chaos, if you talk technically, this is obviously social chaos is a more vital thing, but if you talk about technical things, when your inflation rate is 60% and you are looking at last year's balance sheet which says a company has 1000 crores of assets, this 1000 crore no more means 1000 crore, right? It means 1000 divided by 1.6. In 2 years, this will mean 1000 divided by 1.6 square, right? So this will become less than 50% in just a matter of 2 years. So in hyperinflationary scenarios, in extreme inflationary scenarios, the value of things erodes. And if deflation occurs, let's say instead of plus 6%, plus 5%, plus 3%, the inflation rates are minus 6%, minus 10%. This means demand is slumping. It is falling down at great speeds. And this also generally means depression and chaos. So this is the very reason we must take extreme care when we raise the interest rates. There should be care, because if you raise the interest rates too much, there can be depression or recession. If you raise it too quickly, there can be depression or recession. If you raise it too much, there can be depression or recession. Then, if we raise the money supply, if we increase the money supply too much or reduce the interest rates too much, there can be hyperinflation. Simple examples you can look at a few countries: Venezuela, Zimbabwe, Argentina, even many other South American companies like Brazil, right? Again, also excessive stimulated growth can lead to excessive capital inflows and subsequent financial crisis. For example, you can look at the Asian financial crisis of 1997. This was basically triggered by excessive amount of capital inflows in very small pockets of time. What happened is the baht, the Thai currency, expanded a lot. It went into bubble territory. So the currency became overvalued and the market started speculating against it. There was negative shorting pressure. And what happened is the currency crashed. The currency crashed from a certain level. 1997 this happened. The currency crashed and there was a crisis in Thailand, right? And this crisis spread like a contagion into the other Southeast Asian countries, leading to the Asian financial crisis of 1997. So what happened is excessive amount of stimulated growth, excessive amount of unregulated growth led to unregulated capital inflows, unregulated inflows of capital within a very short span of time, created a bubble in the currency level, and that in turns created a shorting pressure. This shorting pressure in turns created a crash of the currency and the crash of the economic system of those regions. So all these things, when you are changing the interest rates, when you are changing the money supply, when you are adding stimulus, these things become possible. These things become great possibilities. So when doing these things, one has to take care of the consequences very carefully. So this was a brief history about the monetary systems, starting from the barter system to the coin systems, note systems, to fractional lendings, and then to the modern banking system and the tools that are being used right now by the central banks to impact the economics, to impact the economies and their in turn consequences. So this is a very deep subject, friends. We have just brushed through the surface of it. I'll give you an assignment. Your work is to go through the following. First is go through the Federal Reserve System, how the fiat money is created. Try and learn how the Federal Reserve System is working, how the money is getting created in US. That is how the dollar is getting created, right? Second, go through the hyperinflation stories of Venezuela, Zimbabwe, Argentina, and likewise. Go through the history of the Asian currency crisis or the Asian financial crisis. Why it happened, what caused it, try and understand that. See, Venezuela, Zimbabwe, these were majorly currency supply issues. So it was related to exports, capital inflows, currency exchange rates, lending regulations and all those things. This was much more complicated. So go through it once. Creation of the money, this is also very interesting. Go through it once. You can find it in YouTube itself or in Google itself. Just go through them. Number 4, go through the currency crisis of Turkey, the recession in Greece, the Russian ruble crisis. This also happened in the late 1990s, right? Go through this. You will get a great idea how the monetary system and how the export scenarios, in fact, even addition of tariffs, addition of sanctions. What is the role of those things in the economics? How they impact the economics, right? These four things you go through. Go through these four things and also understand how RBI functions. How RBI is controlling the things, right? Understand how RBI functions. So these are very open-ended assignments I am giving you. You go and study these things. There is no particular target to it, but conceptually become clear of it. And if you have doubts, if you get doubts, share with me. We can discuss the different aspects of these currency related issues. One more very interesting topic I'll add to this. Japan. Look at the banking and monetary system of Japan. There is something called negative interest rates, which was primarily introduced and popularized in Japan only. That is, to keep money in the banks, you have to pay the bank money. In India, what happens is you get interest if you keep money in banks, right? In Japan, it is like if you keep money in banks, you will have to pay money to the bank for keeping the money. So how did that work out? When did that start? When did it start? How it impacted the economy? How it impacted the stock markets? Get an idea of it. So all these things, these are very open-ended tasks, right? These are very open-ended tasks. I'm not giving you any specific objectives. Study them. The goal is for you to better understand the actions and consequences of the central banks in short term and long term of different countries, right? Like right now, the USA has 5.33% interest rates. What will happen in the future? If the rates come down, slowly, if they keep on coming down, what will be the impact on inflation? Understand that. Keep a watch on that. Parallelly, for example, in other countries, for example, in India, what is going to be the impact of it? Right? If the economy goes through trouble in USA, which sectors will get impacted in India? And how much will the impact be? Just for example, a huge percent of the Indian IT revenues come from USA, right? So if there is a problem in USA, what is going to be the impact on IT? What is going to be the impact? What is going to be the impact on banking? Because in many ways, every other currency is going to be influenced by the changes in the behavior of the dollar, right? So these things we are trying to understand in a holistic way. There is no closed-ended solution to this. We have to keep learning. This is just an overview that we have given. We have just initiated some learnings here. Each of these slides that you find in this presentation can become a project in itself. So it is your work to expand on it and create questions out of it and find answers to it. If you get doubts, we can also discuss about these things. These are very interesting things and help you get a much stronger conceptual idea about how the systems function in the long run and in the short run. So friends, this is about it for this assignment number 7, which was about the monetary system and the history of the monetary system and the impact of the monetary tools on the economy. The next assignment is going to be about industry specific metrics. Understanding the industry specific metrics. For example, if you are going to analyze a mining company, what are the industry specific things that you should look for? If you are going to analyze an IT company, what are the specific industry specific metrics that you should look for? If you are looking for hospitality, what are those metrics, right? If you are looking for a retail company, if you are looking to value a retail company, what should be the metrics you should be looking for, right? Or for example, if you are looking to analyze an OTT platform, for example Netflix, how should you analyze that? These things we'll discuss in the next assignment, and the subsequent projects will be delivered to you. So here it's an open-ended study I have offered to you. Study these things. Study the hyperinflation incidents of Venezuela, Zimbabwe, Argentina. Study the Federal Reserve System, how the US dollar comes into existence. Study about the Asian financial crisis, the crisis that happened in Turkey, the crisis in Greece, the late 1990s crisis of Russian ruble. Then understand how RBI works. Also understand what triggered negative interest rates in Japan, why was it brought about, and what are the consequences, how the Japanese economy evolved, right? Everybody was predicting Japan is going to take over all the countries in terms of GDP, but it did not. Why did it stop growing? Try and understand that. And to mitigate the slowdown of the country, what were the steps taken? Try and understand that. So friends, we will see you in the next assignment. These are going to be your studies for this particular assignment. Thank you so much.
So, guys, try this assignment surely at home. If you come across doubts, share in the comments. I shall respond. For those who have enrolled to the internship, share your assignments on the mail ID given to you. The enrollment link is given in the description. Hope you enjoyed this video. If this video added value to you, please like the video and subscribe to the channel. Share this with a friend who is interested in finance and investing. See you in the next assignment.